Meet David. He retired at 65 feeling confident. Solid savings, no debt, a plan. Within 2 years, he was paying $487 extra every single month in Medicare premiums, all because of decisions he made at age 63 that he didn't even know mattered. That story is more common than you think, and today I'm going to make sure it doesn't happen to you. As a financial advisor, the question I get most often isn't, how much do I need to retire? It's, did I miss anything? And there is a specific 5-year window between age 60 and 65 where 4 critical financial moves either get made or get missed permanently. These aren't obscure tax tricks. These are real deadlines with real dollar consequences. Miss them, and in most cases, they are gone forever. Let's walk through each one. Most people know that once you turn 50, you're allowed to contribute extra money to your 401k. That's called a catch-up contribution, and in 2026, it allows you to put in an additional $8,000 beyond the standard limit. What most people don't know is that the Secure Act 2.0 created an even higher contribution tier, specifically for ages 60 through 63. It's sometimes called the Super Catch-Up, and it raises that additional amount to $11,250. In 2026, that means someone aged 60 to 63 can contribute up to $35,750 into their 401k in a single year. Here's the part that makes this urgent. The moment you turn 64, this opportunity ends. You drop back to the standard catch-up. There is no extension. There is no exception. You have 4 years, ages 60, 61, 62, and 63. And after that, the window closes permanently. To put real numbers on it, the difference between the regular and super catch-up is $3,250 per year. Over those 4 years, that's $13,000 in additional contributions. At a conservative 6% annual return, that $13,000 grows to roughly $60,000 by age 80. For a married couple where both partners qualify, double that figure. Important note for high earners. Starting in 2026, if your income exceeds $150,000 from that employer, your catch-up contributions, including the super catch-up, must go into a Roth 401k, meaning you'll pay tax on them now. That's not necessarily bad, but it requires planning. Before you do anything, confirm 3 things with your HR or plan administrator. Does your plan offer the super catch-up? Does your plan have a Roth 401k option? Is your payroll system set up to process it? Not every employer has implemented this yet. If you're in that 60 to 63 window right now, this is a question worth asking this week. Age 65 is when Medicare eligibility begins, and it comes with a specific enrollment window, 3 months before your birthday month, the birthday month itself, and 3 months after. That's a 7-month window. Miss it without a qualifying exception, and Medicare imposes a 10% penalty on your Part B premium, permanently. It does not phase out. It does not expire. It follows you for life. What counts as a qualifying exception? If you or your spouse is actively employed at a company with 20 or more employees and you're covered under that employer's health plan, you can delay Medicare enrollment without penalty. When that employment ends, you have an 8-month window to enroll. 2 things that do not qualify and that catch people off guard. COBRA coverage. Even though COBRA is technically continuation of employer insurance, it is not considered creditable coverage for Medicare purposes. If you retire at 65, go on COBRA for 18 months, and then try to enroll in Medicare, you will likely face that lifetime premium increase. Retiree health benefits. If a former employer offers you retiree health coverage, that is also not creditable for Medicare purposes. Same penalty risk applies. The bottom line, put age 65, specifically your initial enrollment period, on your calendar now. Treat it as a hard deadline because that's exactly what it is. Health savings accounts are one of the most tax-efficient tools available to working Americans. Contributions go in pre-tax, grow tax-deferred, and come out tax-free for qualified medical expenses. Because of that triple tax advantage, many people max them out automatically without giving it much thought. The problem comes at retirement, and it catches even financially sophisticated people off guard. When you enroll in Medicare, you can no longer contribute to an HSA. That part most people know. What they don't know is that Medicare Part A can be backdated up to 6 months. So if you apply for Medicare in October, Social Security may backdate your Part A coverage to April. Any HSA contributions made during that backdated period become excess contributions. And the IRS charges a 6% penalty per year on excess contributions until they're withdrawn. The rule: stop all HSA contributions, including any employer contributions, at least 6 months before you apply for Medicare, not 6 months before Medicare starts. Before you apply. Since you can apply up to 3 months before your 65th birthday, the safe window to stop contributions could be as early as 9 months before Medicare begins. If you're on automatic HSA contributions through payroll, this requires a deliberate step to turn them off. It won't happen on its own. IRMAA stands for Income-Related Monthly Adjustment Amount. It's a surcharge added to your Medicare Part B and Part D premiums based on your income, and it uses a 2-year look-back. That means the income you report on your 2024 tax return determines your 2026 Medicare premiums. In practical terms, what you earn at age 63 sets your Medicare costs at age 65. The 2026 thresholds, IRMAA, kicks in for single filers earning over $109,000, and for married couples filing jointly earning over $218,000. There is no gradual phase-in. $1 over the threshold triggers the full surcharge for that tier. The highest tier adds $487 per month to Part B, plus $91 more for Part D. For a married couple both hitting the top bracket, that's over $13,800 in additional premiums per year, before any other coverage costs. Why ages 63 and 64 are critical. For most retirees, this is the lowest income period in their retirement. Earned income has often stopped or reduced. Social Security hasn't started yet if they're waiting for a higher benefit at 67 or 70. Required minimum distributions don't begin until age 73 or 75. This is what financial planners call the IRMAA window, and it's often the cleanest tax environment retirees will see for the rest of their lives. It's also when many people do Roth conversions, which is smart, but every dollar converted counts as income. Going $1 over an IRMAA threshold can cost nearly $1,000 per year in added Medicare premiums starting 2 years later. The math has to be precise. Practical step: pull out last year's tax return. Find your modified adjusted gross income on line 11 of Form 1040. Add back any tax-exempt interest. Compare that number to the IRMAA thresholds for the year you turn 65. If you're close to a threshold, model your Roth conversions carefully. Being slightly under is almost always better than being $1 over. Here's what makes this window genuinely complex. These 4 decisions don't exist in isolation. They interact with each other in ways that can either compound your advantage or compound your mistakes. Delaying Medicare to keep your HSA open could trigger a lifetime Part B penalty. A super catch-up contribution lowers your taxable income, which can reduce your IRMAA exposure 2 years later. A Roth conversion that seems like a tax win could push you over an IRMAA cliff that costs you more than the conversion saved. The retirees who navigate this window well are the ones who look at it as a single coordinated decision, not 4 separate checklist items. Here's your action plan for this month. If you're 60 to 63, contact your plan administrator this week. Ask specifically about the super catch-up, the Roth 401k option, and payroll setup. If you're within 2 years of 65, map out your Medicare enrollment period and put the dates on your calendar now. If you have an HSA, calculate your stop date, 6 months before your application for Medicare. If you're 63 or 64, pull your last tax return, find your MAGI, and model it against IRMAA thresholds before making any major income moves. A sheet of paper with 4 boxes, 1 per deadline with the specific date and dollar figure for your situation, is more valuable than most retirement tools you'll ever find. Keep it somewhere visible. Review it once a year. The window between 60 and 65 is short. The consequences of the decisions made in it are not.